All right, my man. What's going on? What's going on? Caleb Silver's in the house, y'all, from editor in chief of Investopedia. You are here live on the Life Money Balance live podcast. And this is our first show of the Wealth Talk Unfiltered version. And we're going to leave a little space, a little breathing room to make it hot up in here like Nelly. I know you're a hip hop fan, Caleb.
I like that Southern hip hop too.
Yeah,
But
yeah, for
I
sure.
am a New Yorker, so it's Dipset, it's
Yeah. Oh,
LL, it's Tribe,
Dipset. You
it's
know,
PE.
the LL album was slept on. The one that came out last year. Did you hear the full one?
Yeah, yeah, of course.
Yeah, I think it was for sure slept on. I think it was just it's a classic. I mean, it's top 150. For me and albums. I mean, that's a lot of albums. I mean, I give him a lot of breathing room there. But it was
Well,
complete.
you
Yeah,
you
cute.
grew up around Teddy Pendergrass and some of the classics, so when you say top 150, I know you're
Yeah,
going through a lot of stacks to make that call. That's a heavy call.
that's a heavy call. That's a heavy call. I mean, it's on the back end. It's on the back end. But LL put a lot of pen work in there, and he had Q-Tip on the ones and twos. Yeah, I mean, I
What
mean, so
else you
you, I
need? You
mean,
got Queens and Long Island. You got the LIE, the LIE mashup right there.
oh man, good stuff, good stuff. Man, tell me what's going on. First of all, kudos to your new show. I hopped on earlier this week, and you're always skateboarding and giving the world some knowledge on Investopedia and kicking us some daily knowledge with your shorts and everything like that. What brought about the show on Monday?
Yeah, well, there's one of the boards right there. Cooling behind me. No, we took the Investopedia Express podcast, which I've been doing for about 4 years, 240 episodes, who's counting, and we decided to take it live and take it to video. So it's now a live vodcast every Monday at 10 a.m. The Investopedia Express. This is the what I like to think of as the podcast you need for the educated investor to kind of get set up for the week. And we're not telling you what to do. We're telling you what's going on and how to think of it as an educated investor, and then make your own decisions, but really explaining what's happening and getting some of the smartest people we know to come on and join us and help us explain it. We just had JC Peretz on, good buddy of mine, one of the master chartists out there and technical analysts, and you'll be on shortly, I hope.
This is good
But
stuff. Yep.
this is really the Express. It's a fast train. It's like a 20-minute podcast, and we give you what you need to know for the week ahead, and also key terms, key indicators, key trends, looking at money in motion, and just some classic Investopedia stuff that's really right in the heart of where we sit for the educated investor by the educated investor.
For sure. Love me some Investopedia, y'all. So I'm gonna do a special shout out. I'm on the advisor council on Investopedia. They keep it 100 for every. I fully endorse Investopedia for everybody, anywhere on your journey, any where you are in your income journey, in your life journey, any generation, you can find some good information on Investopedia. And I'm a little biased because I published a couple articles there, but under Caleb's leadership and that whole team over there, it's a trusted source. Because Caleb, as you know, when folks get online and get out here in this social media space, there's a lot of trash out here, and people need to go to trusted spaces. So I mean, you got to find people that endorse certain areas, right?
Yeah. Well, if you endorse us, then I think we got to be good. But real knows real in this business, and nobody keeps it more real than you. But we've been in this business of educating investors and educating people about money for 26 years now, Preston. Uh, we are over a quarter century old, and in internet years, that's like 260 years. So why? Because people trust us. We have really good editors. We have really good writers. We have really good people on our board, on our review board like you, and fact checkers. And it's all about the brand and whether or not people trust us. What's awesome about my job is usually when I meet people for the first time and they ask me what I do, and I say I'm the editor in chief of Investopedia, most of the time the next words out of their mouth is thank you. Now,
Yeah,
who gets thanked for their job? You do,
yeah.
of course, because you help people. But who gets thanked for their job? I think that's the coolest thing in the world. I tell my team all the time because they're not out there like I am. People are grateful that we're here, and I'm so grateful and proud to be the editor in chief. But it's really a whole team out here that's doing the work every single day to make sure our content's the best it can be.
That's good. That's good stuff. Well, let's get into it. I mean, the week, right? The week has been just off to a start. I mean, even last week, I mean, we're going to talk about event risk. We're going to talk about the Fed policy. It came out today. So there's just a lot of things going on. The VIX, shot up a little bit, didn't cross 20, but it's getting into that space where people are like, getting that little uneasy feeling. So let's talk about the rates. I said, Jerome, stay pat today. Uh, what else could he do? I think. I mean, the President Trump says he's pounding on the table with the Twitter and going on and say we should be 2 points lower, 2 percentage points lower. But at the same time, I mean, we just got done with massive easing for 8 years. I mean, 10 years almost. I mean, so we really can't go to that, and particularly during COVID. I mean, so doing that right now, that's just as uneasy as raising them and spooking folks. I mean, because we already got a lot of spookiness in there. I mean, what's your thoughts on what was going on about standing pat
Yeah,
today?
I mean, if you're the Fed, there's no reason to do anything with interest rates right now because you just don't know what's happening next in terms of economic policy, namely tariffs. And I listened to Fed Chair Powell's press conference today, like a dutiful business journalist would. I always do. And it's really the questions, the Q&A, where you learn the most. But what he was saying was the economy is in a good space. If you look at the headline numbers, unemployment rate's 4.2%, relatively low. Inflation's 2.4%, nice little inverse there. But that's the sweet spot for the Federal Reserve. It just doesn't know what's going to happen next because the economic policy changes on a daily basis, sometimes on an hourly basis. So how can you set policy or a firm trajectory for policy if you don't know what's coming next? And he was totally candid about that. And I'm sure the president was furious. I said this morning on the news when I was on predicting what was going to happen, 99.9% chance the Fed does the Fed does nothing, 100% chance the president dunks on the Fed chair for not doing anything, but the Fed chair is doing what he should, and what the Federal Reserve and policymakers, it's not just Jerome Powell, there's 12 of them voting on this committee, they're doing what they think is right for the economy, and I think they're doing the right thing as of right now. So you just got to get used to rates where they are for a while, maybe 1 or 2 cuts, baby cuts this year, paper cuts this year, and maybe next year we finally get down under the 4% Fed funds rate. But for borrowers, for people who are earning money in the bank on interest, this is kind of where it's going to be for a while. And this is kind of where it's been. Get used to it and get used to more volatility in the economy with uncertainty with policy.
Yeah, I hear you on that. I was just in a credit union. I'm on a credit union board, and credit unions are very good for those retirees and folks in the community. But for sure, folks and the people with high incomes that are trying to stash some cash. The whole point about what you were just saying. I mean, right now it's good for those that are trying to earn a little money on their cash right now. The interest rates right now.
The flip side, the flip side of these rates is you're actually earning money in the bank, and you have been for the past few years. And we survey our readers every couple of months. What are you doing with your money? Most people are active, self-directed investors, or they work with great advisors like you, and they're putting their money to work dutifully every couple of weeks or every quarter. But if they had extra money, a lot of them are saying, you know what, I'm fine with the money market right now, Preston. I'm fine with a high yield savings account. Give me 4.5% while we ride this out. They're not expecting huge stock market returns, although we're 20% back from that big almost bear market we had earlier this spring. Again, that was policy related. So people are like, you know what? 4 or 5% sounds fabulous right now with extra money and with my savings. So don't really wish too hard for the Fed to lower interest rates. That could spike inflation. That's going to hurt your savings rate.
Now, what about the folks that are out here trying to buy houses? I mean, oh my gosh! I mean, prices right now for as homes are concerned is just very high, and also, I mean, interest rates. I mean, so you got a double whammy. Remember the whammy, go whammy. And you remember that? They brought it back. They brought go whammy back.
Yeah.
They did a remix on go whammy. You know that?
I did not know that, and we got to put it in the show notes now for your listeners. The entire oeuvre of what we're talking about has to go in there.
Yeah. We got LL. I do extra credit in my classes, for culture references. But yeah, the go whammy right now. I mean, there's a double whammy with high prices and high rates. I mean, so for those savers, that's great. But there's a battle. I mean, let's see, one of the numbers this week was permits up a little bit or down a little bit, but home starts still not there. I mean, so
some of the
there's not much
mortgage
supply
demand and refinance demand we've seen in years, and that's just the way it's been. The housing market is probably the only part of the economy that's really in a recession right now. So it's just going to remain that way. Houses remain out of reach for first-time buyers, and those that own and are thinking about selling aren't about to sell to go get into a new home at 6%. Most people have mortgages, as you know, as low as 4%. And a lot of people don't even have a mortgage at all, people that have owned their home for a long time. So there's no hurry for anybody to move or refinance right now. But what we do see is a lot of people putting some money into their homes. And some of that was pre-buying ahead of sort of tariffs or potential tariffs. But even over the past year or 2 years, Preston, people have not been buying or selling. They've been adding and improving to their homes. Really started in COVID and accelerated the last couple of years.
Well, people are graying in place. I mean, I guess as a pun, because you got a little gray going on right there. I don't have no hair. I got like 4 or 5 right here. It's bad. Now with a little later, they're coming in faster, man. But I mean, but people are graying in place. I mean, so they are adding onto their homes. I was just, matter of fact, from Investopedia, wrote an article about downsizing. But I mean, where do you can't buy right now because starter homes are so sky high. So yeah, that makes complete sense that people are just adding on to their homes and just staying in place. And
they're putting their money other places. And you notice this too, probably in your practice and talking to your colleagues. Younger generations feel like that notion of the American dream, that so-called American dream, home ownership, sending kids to college, just the traditional path that we were taught to pursue through financial media and financial services. And that concept, that's further and further away for younger people. In 2023, every year, actually, you look at the top terms of the year. What terms on Investopedia were trending the most, had the biggest spikes in traffic, that were the most sustained? In 2023, one of those terms was the American dream. And we made it our term of the year. And we didn't do it because we didn't think people were out there going, oh, what's the dream? I got to get to the dream. I think people, especially younger generations, were saying that dream is out of reach, right? That whole notion that you guys have been talking about on commercials on the Golf Channel and whatever, that's not for me. I'll never get to that. I can't imagine putting spending $1 million on a home or $1.5 million, paying it out over time. So we actually put a price tag on it. And what would it actually cost to buy the things that you might want? Not the needs, but the wants. A home, right? Pets, a new car every few years, sending a couple kids to college, saving for retirement, marrying off somebody, burying somebody in your family, right? And that came out to $4.4 million in 2024, based on CPI and based on inflation. And that seems like a scary amount of money to people, $4.4 million. But if you work your whole life, 25 to 65, and make the median income, you'll have $3.2 million. You'll still have that gap. And that gap has to be filled by investing. But the notion of, I have to save all this money so I can have those things, I think that's getting further for some people. So you see, probably through your practice and in discussion, more younger people are saying, well, what if I didn't have to make the home purchase? What if I decided that wasn't part of my dream and I could put that money towards other things like experiences, right? Maybe I'd move with my family to Sweden for a year, or they do something different. And that changes how you plan for people like this who have taken the big asset purchase out of the equation. So if we're going to be stuck in this for a while, you're probably going to see more of that developing in financial planning. Okay, if not that, what? And how can we make our money work for us that is fulfilling to our lives and delivers experience, which we know has become much more valuable to people over the last 5 years?
Yeah, no question. But I put a butt there in purpose, on purpose, and I guess we go for a Sir Mix-a-Lot reference. Big butts and they cannot lie, right? That was taboo back in the day, Caleb. I
don't know if it's not taboo anymore.
But you can hear it at the stadiums now, though. You got Sir Mix-a-Lot in like insurance commercials and stuff now.
I was in with a bunch of 4th and 5th graders in the Bronx in a public school yesterday, and they were blasting. We had a DJ. They had Kendrick blasting in there. They had Drake. I was like, excuse me. And the kids knew every word to every single song, by the way.
Yeah, that's what's up. We're going to talk about, I know you got to run here in about 15 minutes, but we're going to chop it up about Gen X being bad grandparents. I mean, the younger millennials went off the wire on a meme the other day and started chatting on TikTok and stuff about how Gen X is, not paying attention to them and all this other stuff. But, as you mentioned, Gen X, they're strained. I mean, because they've been spending so much money on these folks. And yeah, obviously young folks can have experiences and fulfillment and all that because they got room for that because they're in their parents' rooms. By the way,
that's right. They're living down in the basement yelling at mom for more meatloaf while they're playing video games.
That's right.
But I'm Gen X, and I find myself in the sandwich generation, 100%. I got 2 daughters, 19 and 21. I got parents in their 80s. still working, still doing their thing, but it's starting to need a little bit more support. So I got that on both sides, and I'm not complaining, but I'm like a lot of people between, call it 45 and 59 who are, dealing, or 41 and 59 who are dealing with all of a sudden, we're okay. We're part of a generation that did well through investing over time if we were in the game. But at the same time, life has become more expensive for the people we are providing for now. And that becomes a different financial planning challenge as well. One that I'm going through with my wife and our financial planner. It's fascinating.
Yeah, for sure, for sure. Well, let's pivot a little bit while we got you. We were talking, interest rate risks and everything like that, but we got some unfortunate events going on right now too. I mean, these unprovoked event risks that are going on just the last, I don't know, 8 months. I mean, because we did have a presidential, so I guess an administration turn. And so the unpredictability of, President Trump right now, so we, as far as who I serve in my practice, we remain politic neutral, but policy matters. Policy matters. Policy has an effect. We got tax policy out there with the big, beautiful bill. We have event risks. I mean, so actions do have, effect on pockets, portfolios, psychology. I mean, so when we have these event risks coming up, there's one thing to have them, just come up randomly, which they do. Some of these, like the tariffs and what's going on, unfortunately, between the conflict, Israel and Iran right now, they seem a little bit unprovoked, and that kind of has people even more just unease. I mean, the word is uncertainty and anxiety. What's the temperature out there? She's been hearing out there in the world, the data.
Yeah, we survey our readers, our newsletter readers, every 2 months. And we've been doing it since the pandemic. How are you feeling? Bullish, bearish, optimistic, pessimistic? What are you afraid of? Where's the overvalue? Where's the bubble? What would you do with an extra 10 grand? What stocks do you own? What securities do you own? If you could buy and hold for, one stock for the next 10 years, what would it be? So all types of questions, but they're all centered around sentiment, right? How do we feel? But we also like to match that against, well, okay, we may feel one way, but we may not be doing something about it. What's fascinating to me is that we are as scared as we've been since the pandemic, and certainly since the great financial crisis, in terms of consumer sentiment and consumer expectations, and even investor sentiment. If you look at our survey, if you look at the AAII sentiment survey of individual investors, very bearish, very pessimistic because of the policy uncertainty. In the meantime, we haven't been doing much with our money as individual investors, except for about 30% of our survey respondents, and it pretty much tracks with retail investors, who have been buying the dip. They have been buying the dip in some of their favorite stocks. And I'm talking about the NVIDIAs of the world, the Teslas of the world, the Palantirs of the world, chasing the Mag 7s, but chasing other stocks that were hit pretty hard in the early days of the administration and the onset of the tariffs, that have bounced back aggressively. Institutions, and I talked about this on my podcast with JC Peretz this week, they've been sitting it out. They're as bearish as they've been, but they're actually pulling their money out, investing in foreign markets. So the best performing stock markets in the world are not here in the U.S. They're in South America and Poland, by the way, number one, and gold and cash, and record inflows into cash this year. We're not even 6 months into the year, Preston, and there's been a record inflow into cash, almost $1 trillion. And that tells you what institutions, big money, is doing. So while we may be fearful and full of anxiety as individual investors, we still do the same thing every 2 weeks. We put our money in our, we get paid and our money goes right to our 401k, or we contribute to our IRA, or it's being loaded into our pensions. And we don't stop because we treat it like insurance, right? We treat it like a utility bill. It's this relentless bid that our friend Josh Brown talks about all the time. It just keeps happening every 2 weeks. So we don't make major changes. And there's so many of us piled into the same big securities, whether it's the major ETFs or the big, tech stocks or the AI stocks, that it takes a lot to drive a big hole into those and to knock those down. And the market seems to recover very quickly after these big sell-offs that we've had. And if you're not in it right after these big sell-offs and you get out because you're fearful or you can't handle it anymore, well, you're missing the biggest recovery days in the stock market too. So individuals are behaving very different. Even though we feel one way, we're kind of acting differently.
Yeah, acting a little differently. Yeah, it's kind of like jumping in the pool. You gotta jump in there and stay in there so you can warm up a little bit.
Like the cold plunge, right? But also, we preach this. It's like we don't make moves in our portfolio based on headlines, right? If there is a major policy move that is either that is happening or passes, and a new bill signed by the president, and maybe it is the big beautiful tax bill, and that's going to be meaningful to a lot of our portfolios, and especially those of us in well, everybody in various tax brackets, but there's got tons of material in there. That could have an impact. And then we maybe want to make decisions about that, but we don't make headline knee-jerk reaction decisions because we usually make the wrong ones and we don't know when to get back in if we get out.
Right. I mean, the psychology of it too. I mean, when we're talking about these uncertainties, I call it anxiety stacking. There's already anxiety with personal finances. That's already there, as far as lack of quote unquote literacy, and that's on all types of income levels. Right. Just wanting to be better financially educated. There's already just anxiety there. There's anxiety about one's retirement. There's anxiety about everyday money, and then you have the events that go on, whether it be terrorists, whether it be international conflict, and then you stack one more time with the in and out of watching your money, watching your stock portfolio, and just worrying about that. There's already worry, so there's gonna be a compounding effect on having your investments and having the compounding return, but it can also anxiety just compounding. If you keep stacking anxiety one on top of the other, you can control what you can control, right? Which is that, you don't have to check your portfolio every day. You don't have to make a reaction to everything. There's one thing to have a personal sentiment, particularly with war conflict, and that's very natural. And those are kitchen table topics that you should have with your family and your colleagues and your community. But then when you pivot towards your portfolio, that's a whole nother thing, as far as conversations or knee jerk reactions.
Well, you and I talked about this the last time you were visiting because I was freaking out, and so was everybody else. And you have a great way of coaching people on this, which is, and I said, what do you tell people to keep them from freaking out? And you basically said what the magic words of your profession, which are, come back to the plan, right?
Mm.
Now we have rules around the plan, but we have a plan in place. And when we make moves that are outside of that, there better be a darn good reason. But come back to what the plan we established, right? The financial plan we established. And then if there are thresholds on which you can't take a loss because it affects our plan, we make decisions. But we start with the foundation, we start with the plan, and we don't forget why we made those decisions. We write them down. We talk about them with our advisor like you. We study our behavior. I know my behavior. I'm super risk averse, right? Had a lot of financial trauma. And so I'm always, more scared than I need to be, which is why I have an advisor to keep me out of my own way.
A couple of things before we let you go. Gold. So gold with black gold. What was that? The Beverly Hillbillies, black gold. Gold. Here's another one. Making a comeback. LL again. Gold goes in and out of favor a lot, and it is kind of like the fear, kind of like the safety net. People don't, even though there's not enough gold on the planet for us to invest in. But gold is making a comeback in portfolios. Why the hell do you think that is? I mean, you might as well just go ahead and try to find you some gold, like a brick of gold or something like that. But what is this? What is this comeback with this thing? Everybody's just fascinated with gold.
Well, it's a traditional safe haven, right? And it's not just individual investors who like to have it. The biggest central banks in the world have been buying it, right? They've been buying it, but not dollars. They've been buying it, but not as many U.S. Treasuries as they used to. Why? They have the trust and the full faith of this and trust in this government has been eroding for the past several months. Whether or not you like this administration or not, when there is uncertainty, when you realize that what they're doing is fundamentally turning this economy upside down, and it may work, but it's going to take a while to figure that out, then there's going to be a lot of dislocation. So what do you hold on to? You hold on to hard assets. Gold is one of those hard assets. And because big institutions and the biggest central banks around the world have been stockpiling it themselves, and they can actually stockpile it. We can't, right? I mean, we can, but it's kind of heavy. Then something's going on. So, but you watch gold, and then what I think is very curious is Bitcoin, which the believers believe to be the digital gold, right?
Yes,
but it's lost that correlation as well because it is a risky asset, and it's probably going to become even riskier as regulation through this administration sort of fades away around cryptocurrency. We saw the passage of the Genius Act through the Senate today, or through the House today, I believe. Stable coins are coming into our financial system. The president wants America to be the crypto capital of the world. So you used to see crypto as that place that you saw people running for safety. Now it looks much more like a highly correlated asset to tech stocks and AI stocks than anything else right now. Meanwhile, gold, one of the oldest commodities on the planet, people can't get enough of it, and it's at record highs.
Yeah, I think what people need to maybe consider for, maybe perhaps their portfolios and get a really good grasp of it is having allocation to volatility, small, whatever that may be. And gold is a very volatile, crypto is very volatile, and that volatility is what's not correlated to the volatility of the market. The market is, volatile. It has its shocks and whatnot, right? But it's not as volatile. The swings, upwards or downwards, are not as volatile as crypto and gold. And when you do have market adjustments, it's like, okay, what are those? Like I call them like faith, not faith like in spiritual, but like you said, full faith in government. You have cryptos, like, okay, that's decentralized finance. Or you have gold. It says, okay, well, nothing else is working, I'm gonna go with gold, right? Those are volatile assets. If you have a tad bit of exposure to these, this volatility in your portfolio and these belief assets, then they could perhaps, help smooth out rides over 10-year, 20-year periods. Yeah.
That is the big argument for cryptocurrency in your portfolio. Yeah, you could potentially ride it. And if you got in early, you could have ridden to massive gains. We haven't seen gains like this in any asset ever in the history of finance, ever. So let's just start with that. But at the same time, you had to have a pretty strong stomach. And if you could take a 50% hit in your portfolio because all of a sudden Bitcoin falls out of favor or some big whale sells it, the more power to you. But most people can't. But it does prove, like at a 5% allocation or less, with a little gold on the other side to kind of balance it out, and some dollar and some commodity and some other foreign currency. Yeah, these can all be ballast. If you look at the all-weather portfolios that people like Ray Dalio put together, crypto's not necessarily in there, but it's the type of asset class you might see just kind of hanging out on the wings when the wind blows really hard. Sometimes it does stabilize a little bit or provides upside to bring your portfolio back up a little bit when the other asset classes aren't doing that.
Yep. 2 questions for you before we let you go. Sure. And they're tied into the same, which is, is this different? I mean, far as what's been going on the last 8 or 9 months, I mean, folks have their opinions to where we're already talking about full faith, in the government and where we're going. Folks don't want to, occupy again. We're the big, beautiful bills about tax and spending. And then that's what crypto is all about. And gold, we just talked about that, running to what and what may be working in belief assets. I think sometimes it's okay to maybe steer in the direction just a little bit, not panic, but perhaps pivot if this does perhaps feel a little different. But then again, the internet was different in 2000. It was like there was the new world was coming, and it's been growing fast since then. But then again, it's always something, Caleb. So does this feel different, and is it okay to pivot some and not panic?
Yeah, I mean, the 4 most dangerous words in finance, and you know it well, are "it's different this time." It's always different this time. And the internet revolution was one thing. ChatGPT was revolutionary, and boy, did that move quickly, right?
Yeah,
feels like that was like it was 2 years ago, but really in the last 6 months, the acceleration of AI has been bananas. So quick across all industries. So yeah, it's always different, and we have a new administration with a fundamentally different way of imagining how the United States economy is going to operate with the rest of the global economy, and that is going to be dislocating, and it's going to be unsettling. I was at the Berkshire Hathaway annual meeting, as I usually go every year, and you never know when you're not going to, when Buffett's not going to be there, so I always try to catch him. And he was asked this question, and he said, "Yeah, it's different. It's different, but you got to realize every new administration comes in with their new policies, and it's always the same." Now, this one has, the Senate and the House behind it as well, and a lot of the judiciary, and it's seizing a lot of power, and it's aggressive, and it's making an aggressive turn with the way we've been doing things for a long time, and that is going to be unsettling. but eventually things shake out. They revert to the mean. And if you believe that American companies, the companies that we invest in through the stock market, are going to continue to grow their profits, there's going to be innovation, there's going to be productivity, and you have to be invested along with that if you want to increase and build your wealth over time. If you're going to keep believing in that, that's kind of what sustained us for a long time, much longer than this administration will be here or was here the first time around. So you have to have that long-term belief. That said, Preston, when people start to lose faith in the administration's integrity over the capital markets, and they stop trusting this administration to be a safeguard of their investments, I'm not saying they have to make them grow or not. I'm just saying, will they continue to maintain a structure around the capital markets that we can all believe in, that makes sense, that has transparency, that we can operate in as investors and as consumers? If that starts to erode, then we have other problems, bigger problems. And you're starting to see that. We see it in our survey results. Less people trust this administration to be a safeguard of their assets because the policy hasn't been that clear, right? But if you see that start to erode and you see the erosion of capital, and I mean real capital, and individual investors deciding that they don't want to play anymore, well, that changes everything. And I don't think we're there yet, and I hope we don't get there. That's kind of the one thing I'm a little worried about in the back of my mind. At the same time, I'm 54 and I'm all in, and I'm going to stay invested, and I intend to invest for another 25 years at least.
For sure. Well, we'll leave it at that before we pivot to other topics. I'll close with this with you because I know you'll like it. We got to have faith. Yeah.
Michael.
That's the classics, man. My friend.
I want to see the playlist from this episode because we started hard with some Nelly and we're finishing with George Michael. I mean, not everybody can do that.
No, and LL, and I thought about you too. I said, you know what, I'm gonna throw some Where Is the Love? Got some Roberta Flack in there, my man.
You need
all
a
right,
DJ.
Caleb, I love you, my man.
Show.
Appreciate you. Get home safe. Get on that skateboard, my man. All right. Cheers.
Thank you. Thanks for having me.
All right.
Good to be with you.
Yep. All right, Caleb. Appreciate you. Tune in to Caleb, everybody. Where he's skateboarding and everything like that. Tune into his socials. As a matter of fact, before we go, well, I think everybody knows you anyway. But where can we find you on your socials? Because you're always skateboarding and dropping knowledge.
I'm at Caleb Silver and at Investopedia. So you can find me there across all socials, and the Investopedia Express live from the New York Stock Exchange. The new vodcast live every Monday at 10 a.m. You can watch it on demand too. But if you're watching YouTube or Instagram or LinkedIn, you'll see us live at 10 a.m. from the Stock Exchange.
Do that. Find Caleb everywhere. Just like you following Dr. Cherry and all that type of stuff. Find Caleb over there and get your information. Man, appreciate you, man. Really, really love you, man.
Thank you, man. Love you.
All right. Peace out. All right. We're going to continue. It looks like we may have a technical difficulty. So I'm going to pause right here while we closed out the show with Mr. Caleb Silver, editor-in-chief of Investopedia, and then we're going to pivot to some fun topics and maybe get some feathers ruffled a little bit about Gen X, and also can you see wealth, which is a couple of topics that have been top of mind, and one of them has got some meme run on TikTok. All right, so we're going to close up here. This show is sponsored by Concurrent Wealth Management, where we help you align your life and money to help you live your wealth your way, and also Freely Focused Fine Goods, my sister's company. So if you have a corporate event or a school event, mums and a whole bunch of stuff, go on over to Facebook and check her out at Freely Focused, and also go check out concurrentfp.com. All right, we'll come right back at you here in a minute. Cheers.